What is a loan commitment letter, and can you actually get one during the closing process?
So a conditional commitment letter means the loan is fully approved,
Okay.
and the lender is funding that loan.
Okay.
But here's the problem.
Okay.
That is not going to become available till within 48 hours of closing.
Is that because of the 3-day, that 72 hours to get your paperwork together? What is
Not so much.
triggering that?
What's triggering that 48 hours is that we have to re-verify employment. We have to re-verify whether or not the borrower has opened up any new debts within 48 hours of loan funding. So it is impossible, in the true sense of the word, to provide a commitment letter, meaning the lender is writing the check no matter what, until you're within that 48 hours.
Got it.
Outside of that, it is always will be a conditional commitment letter. Give the lender some wiggle room, left or right, to get out of it if things go badly and the borrower chooses to buy a Ferrari or loses his job. I would say that for sellers and agents to not get hyper focused on commitment letters. What they need is a trusted local lender that they can hold accountable to following up and meeting the obligations of their conditional loan approvals that are commonplace. So as long as they're working with trusted professionals that they know is going to follow through, then don't worry about it.
Does a loan officer, John, have any incentive to steer a borrower to one product type over another? In other words, are there products like an FHA or VA loan, for example, where a lender might make a lot more money because of whatever incentives are being offered to them? And does the loan officer, the person who's making the recommendations, do they have the ability to make more money?
Yeah, prior to 2010, this was one of the industry's dirty little secrets, is that loan officers' compensation was directly related to what type of loan product a borrower chose and what kind of interest rate they received. And that was a really black eye on the industry. And thankfully, one of the best things to come out of the economic crash and the legislation that came about afterwards was a provision of the Dodd-Frank Act called the Loan Officer Compensation Act. And it literally forbids a loan officer's compensation from being tied to whatever loan product or whatever interest rate or whatever fees a borrower pays. The only factor that can be a determining factor, loan by loan, is the loan amount.
Right. Which makes sense, by the way.
Of the loan.
Makes sense. Because almost everything in a real estate transaction is based on the amount. What should borrowers today be thinking about interest rates as they relate to the rate of inflation? This is a very interesting concept, and people don't really think about this. So give us your take.
Yeah, well, inflation's all the talk in the marketplace, right? I mean, we know that the cost of pretty much everything is on the rise. You can't pump the economy full of trillions and trillions of stimulus money coming out of the pandemic and not expect that to have some type of effect on inflation.
Right.
Inflation being the general rise in the cost of everything, every good and service that we have to deal with.
Right.
The reason that relates to interest rate is because if we're lending in your example, $300,000 today, and expecting that money to be returned over 30 years, then we've got to anticipate what that $300,000 would be worth over 30 years. And if I can't buy what in 30 years with $300,000, what I can buy today in 30 years, then I've got to charge a higher rate of interest to cover that difference. So as inflation goes up, interest rates will always go up. That's a basic economic principle. When we think about where interest rates might be headed in the future, the inflationary data would indicate that they're probably going up. What we don't see behind that is that the folks buying mortgage-backed securities and fixed income securities are worldwide, and there's still an enormous demand for those type of investments. And that is still driving interest rates lower than inflation. And that's what's creating the big housing boom.
What are just a few common pitfalls for borrowers applying for a mortgage? Like what trips them up? I know sometimes sourcing funds, things like that. Just a couple of things.
It's sourcing funds. You nailed it. There's one thorn in our side, and it's just the way folks might have a lot of cash on hand that right when they get ready to buy a house, they stick that money into their checking account. It's amazing how regularly that happens, that people might be having $20,000, $30,000 at home in cash. A lot of cryptocurrency is a huge thing.
So that's a problem. And I guess the deadline is get the money where it needs to be at least 60 days before you get ready to have before your loan is underwritten. Is that good advice?
You nailed it.